Seems like every day we've got a new theme that you have to navigate. We went from trade worries to tech worries. The latest set of tech results seems to be resulting in tech stocks losing their shine on AI spending concerns. We talked today about how Google's parent, Alphabet, came out with some cloud performance that fell short of some expectations. We also saw chip giant AMD with an outlook that was not exactly well received on the street. Does it mean that there's going to be some kind of turnover in the market? Let's get some insight and analysis now from James Demmert. He is Chief Investment Officer with Main Street Research. James, nice to see you.
Good to see you too, John.
Okay, let's talk about the mood of the market. We had a bit of this tech talk a week or so ago when all of a sudden there was some evidence that maybe you could build the Chat GPT for less than what it has cost to build Chat GPT. And since so much money has been following the AI boom, now people are having a moment of pause here. What's your take?
Yeah, our take is, and thank you for asking, is that the DeepSeek concerns sort of highlight, I think, what we should all expect, that AI is going to become less expensive longer term. And I think investors are making a mistake by selling into that news when, in fact, that's exactly what we typically see in these big technological transformations. Cost of technology goes down, use cases goes up, and the business cycle for tech particularly gets robust. And I think this month so far, or the last 6 weeks, let's say, you've seen some very lumpy returns in technology. And the winners, the big winners, and Google, we can talk about that today, or the Metas. I think there's a lot of expectations built into those stock prices that need to come back down to a little bit more reality. So I think you're seeing some churn there. And then I'd love to talk about AMD, as a company that really wasn't a winner last year, and I'm not really sure it will be going forward. So I think this is an environment where technology, I got to be really particular about the kinds of companies you own and look out to the future of where the costs come with AI.
It's interesting. There is short term, there is long term. This is the dilemma, I guess, in the markets, or perhaps it's the opportunity. And we have to cover quarterly results because for those who are in and out of the market on a short term basis, they're interested in that. But I'm still looking, and correct me if I'm wrong, Alphabet, the parent company of Google, still has capital expenditure plans of around $75 billion for the year. So they're still spending a lot. I guess the question is, how do you want to be positioned going forward if maybe there's some numbers that are changing around?
Yeah, I think that that's important. And I think investors will do themselves a favor by really looking at these earnings calls, which is what we do. And you sort of see in that number that people are disappointed in that they, missed on the cloud services business. But it wasn't because of demand. It was really because they could not supply enough. That's a good thing for businesses. And that $75 billion outlook for AI spending over the next year, holy cow, is that a positive for NVIDIA and the other top tier semiconductors that are supplying those chips. So this is, again, the early stages of this technological transformation, and you really want to go with those companies that are leading. Even on this weakness with Google, I would suggest investors look at that as a window of opportunity.
It was kind of a similar dialogue when Microsoft reported its quarterly results, that they weren't necessarily able to capitalize on all the demand in the short term, but it was a poorly received set of results from that company. So we'll see what plays out from here. But let's dive a little deeper into some of the stock recommendations you have today that are indirectly or directly tied to this theme. So one of the things that came out of this idea of costs going down, is that a good or a bad thing? It kind of opened the door to a conversation here about whether there's a whole group of other players that are going to be able to faster capitalize. Software companies come to mind. So a lot of analysts on Wall Street who quickly started to put the spotlight on there. I noticed that you like SAP. It's a big software company as well. Is that any of your consideration with that one?
Yeah, it absolutely is. I mean, SAP and companies like it, what we call the second derivative of AI. So these are the companies that bought the chips to basically enhance their business model and increase their profit margins. SAP is a great example of that. And, we saw that just in their earnings that came out 2 weeks ago, better than expected on the top and bottom line. So we think that, SAP companies like it in that space are a great opportunity to sort of get that next, our view, the baton is going to be sort of given from the semiconductor companies to the next generation, which is the software companies, telecommunication, eventually healthcare, industrial companies as well, particularly as the chips get less expensive.
And being a German company, you think in terms of this tariff stuff, they have actually an added appeal because of that?
Well, I think they do, and I think any weakness because of tariff concerns, in our view, this is akin to walking tall with a big stick. We think that the tariffs negotiating is just a tool to get to negotiating, and that's why any weakness in parts of the market or a company like SAP, for that concern, is an opportunity for investors, again, in this first early stage of the second derivative companies. You want to acquire these stocks.
James, I also want to talk to you about one of the power players at the center of this AI boom, Constellation Energy, which had a huge move going back to last year, teamed up with Microsoft, and that got people really excited about the sector. When the DeepSeek news hit, the share price of Constellation arguably took the biggest hit, right alongside NVIDIA. It's come off those lows. You like this one?
Yeah, we do. The grid, in any way you look at it, globally, we don't have enough electricity and energy to drive all the EVs and the AI. And Constellation that's right where they live. They live in helping companies get more energy, expand grids, and even when AI gets less expensive, believe me, the volume is going to increase even more. So the energy needs are only going up, and a company like CEG, Constellation Energy, I think is an excellent opportunity, and particularly if you see it have any kind of weakness like we've seen recently.
Okay, James, appreciate the breakdown. Nice to see you. Thanks so much.